In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. Sofi has been going through a lot of hype and expectations over the recent days, and it remains as one of the most popular stocks in the market at the moment. We're going to look at where the stock is now, where it may be going, and if you should be buying the stock. Before today's video begins, if you like my content and would like to watch more stock analysis videos, please like, comment, and subscribe to my channel. Sofi Technologies operates in financial services field. It provides services of loans, refinancing, credit cards, brokerage, and wealth management solutions to clients. It is a company based online and separates itself from conventional brick-and-mortar banks mainly because of this difference between physical and virtual operational environments. Its appeal is the massive user base, the fast growth of its revenue amount, and in the number of revenue streams. Sofi benefits from famous investors who are almost perceived as superstars in this day and age, and the fact that after years of discussions and speculations and theories about how we can create something called a lightweight bank, it's finally technologically mature enough to be deployed to consumers at large. Recently, the stock price went from $15.60 on September 30th to a peak of $21.08 on October 19th. Overall, the stock is performing quite well compared to the market at large, considering that the risk appetite is very negotiable at the moment, depending on which sector you may be interested in. And right now, the momentum is very positive for the stock, and it is more than likely that Sofi will keep having a decent run over the medium term. The main catalysts are going to be the revenue reports every quarter and the expansion and any announcement of expansion to new markets. I mean, keep in mind that we're talking about momentum here and not necessarily the speed itself. The stock market doesn't really hold pure fundamentals to the high grounds, and everything is often a question of relative perception between different securities. Right now, Sofi is having a good run, and the positive vibe around the stock within the community alone is often enough to send the stock price to higher levels. Looking at the stock volume, Sofi has been trading at a very high rate, between 20 million shares to almost 70 million shares a day. That means that the market definitely has its eyes on Sofi and is waiting for the next catalyst to jump in. Looking at the options market, the vast majority of interest and trading volume is around the calls options, because the market sentiment is that Sofi is going to trade higher than the current $20 level. Most of the strike prices are $21 and up. So my recommendation is to keep a position of a decent size in Sofi, and you can buy now, because there are a lot of indicators suggesting that the stock will keep trading higher until at least the reporting date of its next quarterly report. I would recommend to keep a position between 5 to 10% of your portfolio in Sofi shares. Looking at the current environment, I think we have to be careful with having exposures in the equity market. It has been predicted to eventually go through major pullbacks or even recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the QE years and the drastic increase in asset price and the corresponding collapse of their yields, we gotta remember that the market doesn't mirror the economy very well. Sometimes it doesn't mirror the economy at all, because otherwise we would have seen a market trading sideways since 2008, pretty much. And then 2020 saw another big push in asset prices, and this time not just for the blue chips, but also the growth stocks. There are generally two explanations. The first one is that more money has been printed across the world, and because the real economy has been stagnating over the years. The capital then entered the huge melting pot of globalized finance and has been buying up shares ever since. That was the case for quite a while. But now that QE has been touching its end in North America, and that in Europe they are considering of slowing down the speed of printing new money, I don't think that this will necessarily be the most important part in keeping asset prices up or even getting them higher. But this decrease in new money is partially compensated with the increase of geopolitical tensions across the world, and that the more tensions there are, the more money tends to flow to the United States and North America, because it is still perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoil or social unrest. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset price in those sectors remain high, not only due to good fundamentals, but also because there is a very high level of demand. With all these being said, I think that the degree of uncertainty in the market will increase over the next month and years, especially as the expectation for a recession is building up after the Great Party of 2020, and that the recent announcements from the US Federal Reserve about the possibility of a recession in the short-term future all contribute to a higher degree of inherent risk in owning equities. Of course, there are also the buildup of economic difficulties coming from Asia and the potential side effects that this may have on other financial markets around the world. All these elements led me to conclude that it's very important to keep the speculative plays at a reasonable level. A healthy portfolio normally contains a healthy percentage of its positions in sectors that are different. Any of classes of assets that are mostly stable with predictable cash flows, like REITs, fixed income, and preferred shares, should make the big chunks of your portfolio. The rest can be invested in growth stocks or just to stay cash heavy in case there's a very timing-based opportunity that shows up. Overall, I think that the current environment does make me believe that there are opportunities to average down the cost basis, and this is why the initial position should remain small enough so that we have enough capital in the future to benefit from averaging down our cost. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.